There is a look at the U.S. futures. They are buoyant and pointing upward. There has been U.S. inflation, U.S. not inflation, I should not say. Other U.S. economic data has been released. That data, I don't think any of it is big-time inflation numbers. We've had the Philadelphia non-manufacturing index number released, and the current account balance has been released as well. Other measures of inflation are other measures of U.S. economic data waiting for either 9 a.m. Eastern or 10 a.m. Eastern. So the focus is very much on Canada's consumer price index data released by StatScan 3 minutes ago. Let's bring in Charles St-Arnaud to talk about it and analyze it. He's chief economist at Alberta Central and a former Bank of Canada economist. And we'll just remind viewers that the numbers have landed well within the range of analyst expectations. Core inflation comes in at 3.0%, whether you call it median core or trim core. The number's 3.0%, exactly what economists expected. Headline inflation comes in at 1.7%, also exactly what economists had expected. Charles, first of all, thank you for joining us this morning. What's your take on these numbers?
Well, as you said, it's relatively in line with expectations. There's nothing in there that's surprising. I think the Bank of Canada will look at it and be a bit pleased to see that core inflation is coming down slightly. It's still at the upper end of their inflation target, so there'll still be some concern. When we look under the hood, it's a bit the same, like all other measures of core, whether it's excluding food and energy, whether it's the old measure of core, roughly unchanged from where they were last month. So you're seeing some slight easing, but nothing yet that will be I would say kind of a clear sign that the Bank of Canada will be ready to cut yet. It's clear in their mind that they're really still concerned about inflation remaining relatively strong.
Hi, Charles. It's Paul Harris here.
Hey.
Paul and I were discussing earlier on in the show about, do you think that inflation has become, structurally higher? So we had a period of very low inflation over the last 15, 20 years, and now do you think we're going to go to a period where slightly higher inflation? I don't mean like 5 or 6%, but the number moves from between 2 and 4 as opposed to 1 and 3 sort of thing. So do you think that because of the way the world, geopolitical world, or the issue of even supply chains, et cetera, is causing this?
Yeah, we might be. What is going on now is that I think we have a bit more a stickier inflationary process than what we've had pre-pandemic or in the early days of the pandemic. And part of that is all those supply chain issues that we've had. We've upped all the tariffs now that are kind of creating a bit of friction in the system, and that's keeping inflation higher. We also have to keep in mind that we still, I feel, maybe have some limited or a bit of the pass-through from the very sharp depreciation of the exchange rate that we had late in 2024 that might still be having some impact. I've noticed, like, for example, food prices inflation picked up in recent months, so that could be also pushing a bit of the stickiness, especially those core measures that the Bank of Canada is focusing on, includes those food prices.
What is your take, Charles, on the effect of tariffs or Canadian counter tariffs on Canadian inflation?
Yeah, well, it's one source of the pressure. I don't think it's a main source of the pressure so far. Right now, it feels to me it's really more stickiness in the system that is preventing inflation from coming back more in line with the target. But I think we will need to be willing to accept inflation that is between 2 and 3% for the foreseeable future.
Core inflation cooled, as you said. It came down from 3.1% in April to 3.0% in May. How significant is that?
It's a step in the right direction, but I think for the Bank of Canada, they remain concerned by the fact that their core measure of inflation is at the upper end of the band. And that's one part of the equation. When we look also, another measure that I look is, well, what is the proportion of the CPI components that are growing at more than 3%? That also came down slightly. We were at 39% of the CPI components were growing at more than 3% in April. Now we're at 37%. So it's not a big change, but it's a sign that there's a bit of a cooling in there. But it's not yet meaningful enough, I think, for the Bank of Canada to really feel more at ease with inflation.
Hi, Charles. Paul Harris again. Do you think that the world is going through a kind of a more of a stagflationary period where you're going to see slower growth, higher inflation, and in that scenario, what do central banks do? Do they worry about slower growth, or they worry about inflation in making decisions?
Yeah. Well, it's clear that the tariff shock is stagflationary. It will reduce global growth and will create friction and increase inflationary pressure. The hard task for central banks is to balance both sides. What will be the biggest impact? Will it be the weaker growth, or will it be the higher inflation? At the same time, we're in a very interesting period in time where most central banks had to deal with very high inflation, and also I've seen how high inflation have been disruptive for the economy. And I think part of the reason why the Bank of Canada is so concerned about inflation right now is that they have, in some ways, some PTSD from that period in 2002, 2003, when they were expecting inflation to be temporary, and it was not, or it was, but it lasted much longer than they were expecting. So, and they don't want to repeat that same kind of mistake of of being too candid about inflation.
I know you were watching a couple things. You were watching the moving average on core inflation, and also the share of components within the consumer price index that are rising by 3% or more. And we do have figures on those. The 3-month moving average of the core measures of inflation fell to 3.0% from an earlier three-month moving average of 3.4%. That sounds like a meaningful step down in the 3-month moving average. And the share of components within the CPI basket that are rising by 3% or more fell to 37% approximately from 39% approximately. How significant are those two things?
Well, and that's the thing. It's a step in the right direction, but I don't think it will be enough for the Bank of Canada to feel more comfortable. Having, again, core inflation above 3%, even though it's just barely, and that kind of that 3-month annualized core has been above that 3% target for 8 of the 9 previous months. So again, it has been constantly above that target for so long. And the same when we look at the share of components above 3%, at 37%, you're well above historical average, and you're above what would be consistent with inflation at 2%.